I don't think the music worked.
Did not work.
Hello and welcome. You're joining us live on the Investor Lab. My name is Goose.
My name is Gabby.
Yeah. And who's this mustachioed bandit that we've got here? Callum Rhodes, head of finance at Dashdot Finance. How are you, Callum?
I'm great, guys. Look, I wasn't expecting a rendition of a song, so I wasn't quite prepared for that, but you're off to a good start.
It's not quite Hamilton. It's not quite Hamilton the musical, but I am working on it. Okay, so we'll get there. We'll get there. Super excited to have you here, Callum. Obviously, property investing is a game of finance with a few houses thrown in the middle. We all know that. Over the last couple of weeks, the predominant nature of questions. Let me actually rephrase that. The predominant nature of questions that we couldn't answer very well were all finance related. So we thought, shit, we better get you on here so we can actually start tackling some of those. And if you're joining us live right now, welcome. Let us know that you're here. Let us know in the chat. Say g'day. Let us know where you're from. Let us know who we've got here, because we are here doing this live so that we can be here with you live. And if we don't know you're here, then hell, we may as well just do it not live, But so let us know if you're here. Morning, Matthew Pitt. Good to see you. Who else? We've got a few other people coming in as well, which is awesome. I'm excited for today's topic, Gabby, or topics. What do we want to get out of today?
Well, honestly, I want to approach this as much of a Q&A as we can. So, guys, if you are here in the chat and you have any questions about finance, loans, interest rates, finance strategy, what you should maybe think about doing this year because you want some guidance, that's really what we want to build this whole episode about today, because we can show up and we can talk for hours probably about all things finance, and we can make stuff up, or we can actually hear what you guys want to talk about and use that as fuel. So as soon as you have a question, chuck it in the chat. We will pick up as many as we can. We have had a few people submit questions during the week as well, so we can cover those as well. But yeah, I really want this to be interactive, because I think if anyone's been to an episode in the last couple of weeks, the Q&A is always my favorite bit, because we just get to kind of go on tangents that genuinely really serve you.
I like that. If anyone's been to an episode, that's kind of like cool. You usually say that. Have you been to an episode?
Have you been to an episode?
Have you been to an episode? Have you been to an episode? Before we go any further, I would just like to congratulate Braden Warhurst on working out how to change his YouTube name. It is no longer his business name. So congratulations, Braden. Nice to see you there. Nice to see you, Peter. Braden. Jason, welcome. Good to see you here as well. So we've got a good few people here. Should we get stuck into it?
We should.
All right, cool. Callum, I want to know, what's your hot take on interest rates? Because last week, I think it was, Macquarie Bank cut fixed interest rates on at least one of their products. I think it was only like one kind of like weird product where it was only for homeowners with a 60% LVR. It was like kind of something obscure like that. Nonetheless, it was a pretty good signal that a major bank, not one of the big four, but a major bank was starting to cut interest rates. Last I checked, we had a 78% probability of an interest rate cut on February 18th when the RBA meets. What's your take on all of this?
That's a good question. So even going back to the past few months, the major banks have kind of been dangling the carrot a little bit with fixed rates over 2 and 3 years, probably 0.5, 0.7, even 1% lower over 4 or 5 years than what the variable rates are. So that's usually a pretty strong indication that rates are going to go down. And the last thing we've seen in the past month is the banks actually offering better pricing discounts on variable loans, obviously in the anticipation that, in a month's time, they're likely to put their rates down as well. They're kind of getting ahead of the curve to gather a little bit of business in the meantime. So I'd say very high likelihood of a rate drop, if not this time, certainly the preceding month after that.
Yeah, super interesting. How low do you think rates are going to go this year? I know it's pure speculation, but I'm just interested in your take on it.
Yeah, well, look, as I peer into my crystal ball here, it would seem like most economists are suggesting 2 at least, which would be amazing.
Right, two rate cuts, two
rate cuts.
Yeah, but are they 25 bips? Are they 50 bips? Just to use the kind of like, Finbro parlance of bips. Are we looking at 0.25%, or are we looking at 0.5%? Like, where do we think these are going to go? Because if I look at the last time I looked at and I'll bring it up now, actually, I'll see if I can find it. The RBA interest rate futures on the ASX, it looked like we were pricing down to fact, let me just check this live. So everyone just hang in here for a second. It's currently looking like it's going to get down to 3.47%. The market's pricing is going to go down to 3.47%. That's the RBA cash rate. Actually, 3.465. So that'd be, that's a decent cut, considering where we are at the moment. Do you see that playing out?
Look, I think that's probably a little bit of wishful thinking. I think there's probably going to be a little bit of progression down towards those numbers. Maybe we get 0.75 over the course of the year, but I'm not sure we'll be in the position where we're getting substantial drops like that.
Okay, fair enough. So great to see some questions coming in the chat. And just a reminder, if you are watching this live, make sure you drop your questions in the chat because we will get to them too. So how much does an interest rate cut affect people's borrowing capacity? So let's say you have a 25 basis point cut, 8.25%. What does that translate to in people's borrowing capacity? Because one of the things that I'm most interested in is liquidity, right? Now, interest rates are an interesting mechanism that can drive more liquidity, but rising interest rates don't necessarily tighten liquidity, but lowering interest rates can increase liquidity because it can increase the ability to access credit, and money is created through credit in a credit-based monetary system. So, how much does 0.25% interest rate cut impact people's borrowing capacity?
It's a really good question. I think. Sorry to burst some people's bubbles, but a 25 basis point interest rate drop really doesn't make that much of a difference to your borrowing power. It's only 2 to 5% in most circumstances. So through time, if we get consistent rate drops, it really starts to make a difference. But I think one thing that property investors probably want to keep front of mind, if their strategy is predicated around waiting for an interest rate drop, it's really only going to make a marginal difference to your borrowing power, and you're better to just take action at the time that suits you versus some sort of reluctance just based on an interest rate drop.
So does that kind of point to the fact that if people are hanging around waiting for an interest rate cut, I think it's pretty exciting that it looks like we're going to get an interest rate cut on the 18th of Feb. But based on what you're saying, people shouldn't be waiting for that. They should probably just get started now. Is that kind of what you're saying? And if they it's kind of like some second and third order questions in here. If they do, what's the right kind of structure? Would it be better to go variable so that they can refinance again later on and kind of keep capitalizing on the benefit of rates as they come through? How would you think about that? If someone's sort of sitting there going, look, I want to invest in property, but I'm going to wait for the rate cuts before I do it. How would you think about tackling that?
Yeah, so I guess the thing is, if you weigh the numbers up in the loss of opportunity costs that you have from not being in the market for a period of time waiting for an interest rate drop, especially given that we're only talking about 25 basis points, I just don't see any scenario where you would be in front in that circumstance versus just taking action. And if that's buying another asset, for example, the rate cut isn't going to make a marginal difference toward that. So you better just act now. And then if we're to think about fixed versus variable rates, what you'll tend to find is most experienced property investors aren't super fond of fixed rates. And there's a variety of reasons for this. The first one is that it reduces your ability to be nimble, and especially in an environment where interest rates are going down. What happens is, let's say if you jump at the first carrot that gets dangled in front of your face, which is a low fixed rate from a bank, what happens in the environment where interest rates are moving down, you can very easily end up in a circumstance where it'll cost you quite a lot of money to break that fixed term and leave that bank. So you lose the ability, without it costing you quite a bit in break fees, for you to be able to refinance to another bank, access equity, and be able to move on things fast. So generally you would find for most property investors that you would only fix a loan if there was a particular period of time where you thought maybe you weren't likely to make any moves, or maybe it was a particular budget related constraint that you had that you thought, okay, well, our income's reducing, we're just going to take this 2-year fixed rate because we know that we can afford that right now. But apart from that, I would generally err on the side of variable rates and just be reluctant to jump straight into the first good fixed rate that you see.
Yeah, super interesting. And another way to think about this as well, which I just thought about as you were talking about it, it's kind of like we're talking about a 0.25%. By the way, I just checked the probability. We're at a 95% expectation of a 0.25% rate cut. So, I mean, it doesn't get much higher than that. But if you think about it from the perspective of opportunity costs, if you're hanging around waiting for a 0.25% interest rate cut, but the monetary supply is increasing by 10% or more at the moment a year, and property goes up at more that like you could be giving up 10% gains to try and get 0.25% gains, if that kind of makes sense. It's like it's kind of a funny game to play. It's like I want to save 0.25% versus making 9.75% in that kind of same. It's a kind of bizarre way to think about it. It's like picking up pennies in front of a steamroller kind of thing. It's kind of quite weird. So fundamentally, there's no real major reason to wait. People should just get stuck into it and keep playing the cards they're dealt and stay in a variable loan so they can refinance out. Yeah, that sounds pretty good. Gabby, have you got any thoughts in here?
Well, I was just thinking the demand also shifts as well, right? Like if you can imagine all of these people sitting waiting for rates to drop, and every time there's a little drop each month, more people come into the market because they've all been waiting for that drop. So there might be a marginal slight difference, but the increase in demand and competition for you as an investor is going to go up. So it's weighing that up as well.
Yeah, if you think about that as an amplifier as well, it's like, let's just say hypothetically you had the choice to pay like let's push it to the edges a little bit, right? Let's just say there was going to be a 1% interest rate cut, which would be pretty significant, right? That'd be way more significant. Would you get into the market now? Let's say you could get into the market now at 1% higher than what somebody else was going to get into the market in like 2 months' time or something like that. But when the interest rate goes down by 1%, the demand will surge. So the net gain you would get would be significantly greater than that 1% anyway, because you're going to get an amplifier, a multiplier effect from more people pushing into the market. So you could kind of argue that it's almost, if you believe that interest rates are coming, it's almost more advantageous to get in ahead, even on a higher interest rate, than it is to wait because of the demand surge that will come off the back of it, which will likely drive up asset prices anyway. Does that make sense?
Definitely. Yeah. I think on that note too, I think there's probably an overestimate in your average investor in terms of how much one rate drop will actually influence asset prices. I think even some people were, they have the mentality of referring back to some of the crazy gains due to the inflationary pressure we had around COVID times. And it's like one change to the interest rate environment isn't going to create this drastic surge in asset prices that maybe some people have the misapprehension about.
Yeah, so I 100% agree with you because, and I think it's incorrect correlation, or correlation, not causation, is probably the right way to think about it. Because during COVID, interest rates went down and asset prices went up. So everyone goes, "Oh, look, it's because interest rates went down." It's like, no, it's because they printed shitloads of money and pumped it into the system, and that flowed into assets. So it was actually specifically the increase in liquidity that drove the asset prices higher. The interest rates were just a function of keeping money moving around the economy in a better fashion. So I don't think that. So firstly, I agree with you, Callum, that I think people put too much weight into what happens when interest rates drop. But from a psychological perspective, that does impact demand because people overemphasize how important it is. They think, "Oh my God, this is the thing I've been waiting for." And so it can actually trigger more people to participate, even though in practice, it's actually not that big of a deal. Like it's not a significant event, doesn't matter that much. But for a lot of people, that'll be the trigger to get them off the couch and get them moving. And on that basis, that'll drive more demand into the market, and more demand, particularly in an environment where we've got significantly constrained supply and in an environment where we have increasing liquidity. Like there's a lot of non-QE based activities that are driving liquidity up in the Australian market right now. So if you have an increase in nominal liquidity, you have a decrease in trimmed mean. So the latest trimmed mean CPI figures that just came out from the RBA, they're crashing down. If you look at the charts, like straight down and to the right, so that's going down. Household savings have doubled in the last recent period since I can't remember where it was. I mentioned it on the last episode, but they've doubled pretty recently. So we've got a lot more sort of cash sitting on the sidelines. Consumer sentiment is starting to spike upwards. So there's sort of more cash floating around in the economy. There's state and federal balance sheet drainage and budget deficits happening, which are pushing liquidity into the market. And so you sort of got all these other factors that can support rising assets. And so sometimes it's just the psychological trigger that's going to get people off the couch that can actually make the difference. And I think that this could be one of them. And so if you kind of combine that increase in activity with the other structural things which are actually move the asset prices, that's where I think even a small signal like this could be something that can start to kind of like trigger these kind of movements, an event-based trigger, if that makes sense. Do you agree?
That's difficult to argue when you present the information like that.
Nice.
Awesome.
Well, hey, we've got a couple of good questions here. So, and we do want to get the questions through the episodes. So,
yeah,
Matthew, you want to ask Gabby, or you want me to ask?
No, I actually thought I know I will come back to Matthew's question, but there's one from Peter Boone. Hey, Peter. Related, right? Would you wait for the majority of rate cuts before refi to a lower rate in 18 to 24 months, or would you refi from the first rate cut?
That is a really good question. So one thing that we've seen, particularly in the past 12 to 18 months, is banks getting more aggressive in passing on rate cuts and trying to make sure that their existing clients are serviced and are still on competitive rates. So going to Peter's question here, I would really just take the opportunity to refinance at the point in time that it suits you, whether that's a lower interest rate then or equity that you might need for a future purchase, which Peter, friend of the business, that's definitely your circumstance. The bank is very likely to pass on full discounts to you, and they're very aggressive on the pricing front. So I would say take action at the time that suits you.
And kind of just to kind of go back to the point we were making earlier, is that the actual impact is not that much, right? If you're talking about a 25 bips here or there versus taking action and moving, like you can sit out of the market for 6 months, and depending on your capitalization, that could cost you tens to hundreds of thousands of dollars of opportunity cost waiting for a 0.25% shave on the mortgage rate. So it doesn't seem to make a lot of sense, particularly in the context of the question here. Would you refi to lower rates in 18 to 24 months? 18 to 24 months, I mean, depending on your capitalization, that could be hundreds to several hundreds of thousands of dollars of opportunity cost versus, taking a little shave on the. And by the way, you don't have to wait. Like you could, if you have a variable rate mortgage, you can refinance and keep refinancing and keep jumping into the next best thing as you keep going along, as long as you're prepared to do the paperwork. So you can still capitalize on the benefits as soon as they come along, whilst also getting into the market and making the most of it at the same time. Sweet.
Awesome. I will come back now to Matthew's question. Let me just pull it up on here. Thoughts and comments on the new interest-only loans, e.g. 10 to 15-year interest only.
So I didn't even know about these, Callum. I did not know that there was new interest-only loans, 10 to 15-year interest-only loans. What's going on with them?
So it's something that's not commonly known because there's only a few lenders that do it. So ANZ, Resimac, they've been doing it for quite some time. I think what Matt in particular is talking is Commonwealth Bank have recently changed to allow 10 years of interest only. So I mean, it's a great product. It can be more set and forget. It's just that the income levels you have to have a loan approved on a 10-year term are higher because you have to show the bank that you can approve it. You can afford the loan on a 20-year term. But if it's available to you and you can take it, absolutely, it's a no-brainer. It limits the amount of additional work you're going to have to do in 5 years' time to try and renegotiate an interest-only term. So
just to be clear, so like the typical loan structure where you would get interest only would be a 30-year mortgage with a 5-year interest only period and then 25 years to pay the principal and interest. In this context, you're talking about, let's just call it a 10-year interest only period on a 20-year loan. Is that right?
30-year loan term, but the way that the bank assesses your ability to afford that loan is they say, well, if you're not paying that principal down for 10 years, you have to show us that you can afford to pay the principal back in 20 years. So it's a tougher assessment versus if you're applying for just a 5-year interest-only loan. But there's also another interesting phenomenon that we've seen is a number of lenders moving into the market with 35 and 40-year loan terms. So I think that's probably more the thing that's going to make the difference to overall borrowing capacity. And if you think about I suppose the average retirement age now, and that people are working longer and people are living longer, in my opinion, it makes sense that we have longer loan terms to reflect the typical working period of people out there at the moment, and that can make a drastic difference to someone's borrowing power to be able to purchase a house to live in or purchase more investment properties.
It's quite interesting because I remember when they first started getting talked about, and everyone's like, "Oh my God, we're just trying to trap the youth into debt for even longer, and oh, this is such a terrible thing." And oh my God, what are they going to have next? 50-year loans, 60-year loans? People will be entrenched in debt for the rest of their lives. And I'm like, God, give me a 1,000-year loan. Like, imagine that. Imagine if you could get a mortgage on a property that had a 1,000-year repayment period. Oh, that'd be the best thing ever. Like, sure, like over the total life of the loan, it's going to be worth a lot more than the original purchase price of the house. But effectively, when you're getting debt and when you're getting credit, you're shorting the currency. So if you can understand that monetary supply is going to continue to increase, by the very specific nature of the fact that it's a debt-based monetary system. So as we create mortgages and loans and credit, we're manufacturing more money into existence. So the very nature of the activity is debasing itself. It's like a snake that's eating itself. If you can understand that the only path is that more fiat currency is going to be created, more political currency is going to be created, it's like you want the longest loan possible, particularly if it's interest only, because if just for anyone who's listening who hasn't quite done this mechanical math in their head, if you're paying principal back, you're only actually gaining the interest rate on your property. So let's on the loan. So let's say you've got a 5%, or let's say you've got a 6% interest rate or a 7% interest rate. You're only actually earning 5 or 6 or 7% on your money by paying back the principal in that kind of practical sense over any given period of time. So it's a pretty, like, if you can't beat that, if you can't beat like 7% by investing your capital somewhere else, there's something very wrong, right? So it's kind of the least efficient investment return that you can possibly get paying back your principal. So if I had a choice, I'm like, yeah, give me a 1,000-year interest only loan, no problem. Like, particularly if you're buying a hard asset, a scarce asset, like, which is what real estate is. The beauty of real estate is that it's a scarce, desirable asset. It's scarce because there's specific restrictions on how much real estate can be created at any given point in time. It's desirable because it has a significantly high utility value, all of that kind of stuff. So you can buy a scarce, desirable asset which structurally underpins the foundation of the whole country's economy. So the government's never going to let it crash. And you can pay that back over an extended period and just short the fiat political currency further. I'm like, give it to me now. How do we get those, Callum? Where are they?
Yeah, I wonder, Goose Junior the Third, how he would feel about your 1,000-year loan.
I think Goose Junior the Third would love it. Goose Junior the Third would be like going back to Callum Junior the Third, going, can we refi for another 1,000 years on an interest only, please? Thanks. It's the best thing in the world. By the way, anyone who wants to get their head around debt as a mechanism for wealth creation, there's a great book called The Debt Millionaire by George Antoine, I think. I'll look it up. I'll leave it in the show notes as well. It's a really great book on how to think about debt as a wealth creation tool as well. But anyway, sidetrack.
I want to know your opinion then on offset accounts with that in mind, in terms of, if you're saying, 5 to 6%, whatever your interest rate is.
You asking me or Callum?
Both of you. I'm just keen to hear, like, putting your money in an offset account, which I think has traditionally been one of the best options for people, obviously, to reduce their repayments. But how would you think about that now in terms of trying to meet certain investment returns?
I have a strong opinion on this, but Callum, do you want to go first, or do you want me to go
first?
Well,
so I guess it really depends on your risk appetite and the stage of life that you're in. You might have someone that's towards the end of their working life that have quite a large capital base and they're happy to just get a 5 or 6% return. But from my self perspective, for my money, I'm going to want a far greater return than that. And I think it's a little bit short-sighted to focus on, reducing 5 to 6% versus what opportunities you might have with that money elsewhere.
Yeah. So I think I'll expand on that. I agree, and I'll expand on it a little bit further. Because the way that I think about it is everyone probably needs a certain amount of liquid capital that they can access easily in the case of any kind of need or emergency, right? Whatever that is. And for some people, that's, a month's worth of living expenses. For some people, it's 3 months of living expenses, whatever that is. There's no, some people it's longer. I think longer is probably a little, you could have other liquid assets, but the point is, at some point you're going to want to have sort of some kind of cash lying around. You don't want a lot, because having cash is the only way to guarantee you'd get a negative return. But instead of having, if you're going to have some cash lying around that you can access, you've got a choice: put it in your savings account and have it be debased by 10% or more a year, or put it in your offset account and earn 6 or 7% on it, and therefore it's only being debased by about 3 to 4% a year, right? Which is going to be a lot better. So it's a good way to kind of preserve some of the purchasing power of your readily available cash. That's one thing. That's one point to make. The second point to make is income management. So if you have a property that is negative cash flow, you can manage that cash flow by putting your savings into the offset account, to the degree that if you took it out and went and, let's say you went and bought Bitcoin, which is non-income producing, you may find yourself in a tight financial position because you now have these additional payments to make. So you have to actually look at what the income side of the equation is, right? It's not just chasing returns. You can actually go broke. You can go broke making money, basically, right? So you actually do have to think about the income side of the equation. And so if you're in a situation where, let's say you've got a decent amount of money sitting in an offset account and your options are, I don't know, pull it out and buy Tesla stock, for example, that might be a great decision in terms of gains that you could make. Not financial advice, go do your own research. But if that means that you can't afford the repayments, then that's obviously a silly move. So there are situations where the necessity of it actually is the superior move, because it's going to help you to support the lifestyle that you need and or have, right? So there's that point. Outside of that, though, yeah, I mean, you should be seeking superior gains. You should be seeking alpha, because, as I just pointed out, you're not actually going to beat the rate of debasement. So you can preserve some of your economic energy, but you're not going to beat the rate of debasement just by keeping it on the interest rates, right? So I think that's an important kind of point to think about as well. Peter Boone has just corrected me there. Debt millionaire is George Antone. Thank you, Peter, for that as well. So I think that's an important thing to think about, but I think people can overdo it. I think people can kind of just go, okay, the way to wealth is just to offset my debt. And it's like, well, yeah, sure. If you believe that getting a 6 or 7% return a year is good, which it's not, then sure. But really you need to be seeking, 10, 15, 20%. I've mentioned it before. Our personal hurdle rate is a minimum of 20%, but I target 40%. That's what I want to see a return on our capital every single year. So I think it's important for people to think about that. The other thing to consider in here as well, and I'd like to ask you, get kind of like, seeing as how you're the finance expert, Callum, redraws versus offsets, because I think a lot of people get confused between the two, and they think that they are basically the same. They think, oh, I've got a redraw facility. Yeah. I'll put all the money into the redraw facility versus an offset facility. How do they differ, and why shouldn't people think about them being the same?
Yeah, I think it's very current at the moment. There's a lot of content out there online about this particular topic. So in terms of the interest saving functions of both, they're the same. $100,000 you have in your redraw versus $100,000 you have in your offset account equals the same amount of net interest savings. But the primary differences is in terms of, number one, the way the tax office would consider that money if you decide to take it out and use it for some other purpose, which you need to seek specific advice on it. But effectively, if you deposit a heap of money into your redraw and then decide to take it out for some other purpose, you can easily end up in a situation where the tax office would deem that money to be not tax deductible. So that's one thing to pay attention to.
Can you say that again? Can you go back, replay that?
Yeah. So if you let's imagine, I'll give you a live example. So let's imagine that you had $100,000 of cash, and you decided that you were going to put that into the redraw of your loan, versus you decided you were going to put that $100,000 into the offset account of your loan. So what the tax office will say is they'll say that $100,000 of cash that you have sitting in your offset account, that hasn't reduced the balance on the loan. That's just the bank giving you an interest saving benefit from the cash being in the offset account. Now, if you've actually put that into the loan account, the tax office will say, no, you've actually reduced the principal on that loan account. So you can end up in a situation where the tax office can say to you, well, no, that cash that you've taken out for, that was previously the purpose of that was your home loan, and we don't want to treat that as tax deductible, which is something that you don't have if you didn't pay the principal down in the first place. So you can just end up in a situation where you have to restructure a lot of loans that you wouldn't have to have done in the first place if you just used an offset account. That's the first primary difference. And the second difference is money that you have sitting in an offset account is covered by the government banking guarantee. So what that essentially means is, let's say that you're working with some small lender, some non-bank, and they happen to go under. If the money is in the redraw, what happens is that loan is considered paid down, so you won't get that cash back. Versus if it's in an offset account, the government bank guarantee covers that. So in theory, you can still retain that cash. Effectively, it's covered by the government. But I think the thing that a lot of people like about a redraw versus an offset account is the forced savings aspect of a redraw, which I definitely see the value in that, because the challenge some people have with offset accounts is it's like a bank account. So if you're trying to be tight with your budget, it's very easy for you to just use the debit card attached to that offset account and perhaps be frivolous with your spending. Versus if you have all that additional cash sitting in your redraw, you have to have that thought process in your mind before you spend it. Well, actually, do we need to transfer out that $500 to buy X item? Versus do we actually need to buy that and let's just leave it in the redraw?
Yeah, but the easy answer for that though is just don't have a debit card attached to your offset account.
That's true. You're still giving yourself more opportunities though. But yeah, because it's got could be BPay, could be whatever.
Sure. Okay, I think that's good. Can we? I want to get on to Gabby. I want to just jump forward a little bit. There's a lot we could talk about. We're 30 minutes in, so that says to me we could probably have a 2-hour conversation about all of this kind of stuff. There's a couple of key things that I really want to make sure that we tackle in this specific episode. One is debt recycling strategies, and the other one is SMSFs and trusts and finance. So I want to make sure we get to those two topics, and then maybe we can circle back on some of the other ones. What do you think?
Yeah, awesome. So we do actually have a question that came in during the week from Matt, and there's a similar question from Katie. I'll pull them both up. So let me just bring this up here. All right. So, hi guys, my name is Matt. My wife and I have purchased 3 investment properties with you, and they have performed outstanding. Recent portfolio review showed about $760K equity in essentially 3 years, which is awesome. My question is about...
Can we just stop? That's why you don't sit out of the market for 12 to 18 to 24 months waiting for an interest rate cut, because in 3 years you can make 750 grand. So anyway.
Cool. My question is about debt recycling. We have our PPOR house, which is valued at between 700 to 750K and owe 240K. Should we look at selling down an investment property, paying off our PPOR and drawing out equity to use on another investment property? My wife is currently working 3 days a week, but is pregnant again and going on maternity leave for another year in April. So our income has reduced a fair bit. Would love to get your guys' thoughts on this. Cheers. Cool. Debt recycling.
Yes. So if we start with the debt recycling side of it, what it essentially is, it's, as the name suggests, it's you recycling a particular loan to have a different purpose. So in this scenario here, what they're talking about doing is they sell the investment property and have this pile of cash, and they actually pay off their home loan. Now, what the tax office will say, and again, you need to seek advice on this, but you need to clearly delineate what the purpose of a loan was. So at the moment, the purpose of that loan they're talking about is a home loan. So there's no circumstance where the tax office would consider that to be tax deductible. However, if they paid that loan down to zero, and then they decided to re-borrow that money and then happen to use that money for some investment purpose, like buying an investment property, the tax office would say, okay, well, you have now turned that cash into this tax deductible investment loan. We'll allow you to claim tax deductions on that particular loan. There's 2 benefits to this. So the first of which is obviously the tax aspects, which your accountant can help you with. But from a borrowing power perspective, this positions you to have far greater borrowing power, because when banks do their calculations based on the fact that you get the negative gearing benefits for an investment loan, you can borrow substantially more money if it's an investment loan versus if it's a principal or interest loan. So if we consider the 2 loans next to each other, $240,000 home loan, let's call it, versus $240,000 investment loan, your borrowing power is greater with the balance shifted towards investment loans.
Makes sense. Gabby, I was just trying to send you an image that I found that was pretty good. I might try and send it to you, or we could share it later. But just to kind of cook that down a little bit, though, right? So let's say someone's got $1 million property. Let's put some edges around it. Let's say they've got $1 million property and they managed to pay it off, right? So awesome. Now, actually, let me rephrase that. Let's say they've got $1 million property, and they've got $500,000 of equity in it, i.e., they've paid off they're at 50% LVR on the loan. Now, none of the interest on their principal place of residence is going to be tax deductible as an investment expense, correct? Right. So there's no tax deductibility on that income. But if you took, let's say, $200,000 out of that $500,000 of equity, if you split that loan, took $200,000 out for the purpose of it being to go to an investment property, then the purpose of that loan would then be investment, and therefore the interest on that $200,000 of equity that you're taking out of your principal place of residence, the interest on that would be tax deductible as an investment expense. Is that correct?
If you actually used it for some investment purpose, you actually have to have it invested to claim that.
Yeah. So if you actually did go and use that as a deposit for an investment property and bought an investment property with it, so then in effect the investment property would have, sort of in a very roundabout way, would be 100% LVR, because you would have $200,000 which would have come out of your PPR, but 100% of the interest on that property would be tax deductible, including the interest portion on the $200,000 that's come out of the PPR.
Correct.
Awesome. Does that kind of make sense to you, Gabby? Do you think we've explained it?
Yeah.
Have we articulated it well enough?
I think
so,
probably
guys.
Sorry, you go, Gabby.
No, I was just going to say, if there are any questions, if anything still doesn't make sense, just let us know in the chat and we can cover anything as well. Cal?
Yeah, I think probably the one part of this question that we didn't cover often is the conversation around whether you should sell down the investment property. And that's probably the critical part of the equation here. It's like, well, what are the long-term prospects of that particular asset versus some other asset that you may buy instead as well, which is probably the bit that you'd want to start with here.
Well, I think it's a good point. It actually kind of goes back to kind of what we were talking about earlier. So let's say you've got an investment property and you could sell the investment property and pay down your PPOR. So then you could do a debt recycling strategy by splitting the mortgage and doing all that kind of stuff. The gain is only going to be the value of the interest on the mortgage, right? Versus, so you would have to arrive at a thesis where you'd say the investment property that I'm going to sell is going to grow by less than, let's call it 7% a year over the next X number of years, which is possible. It's quite possible. So let's say you've bought a property and it's gone up significantly over the last couple of years. It's reasonable to ask yourself, is it going to continue on that trajectory, or is the growth rate going to beat the interest rate that I would get if I kind of paid off the loan and then use it to split the mortgage? So you've got to do a value assessment on what's going to give me a better return. Is it going to be a better return to keep my capital? Bearing in mind, on your investment property, you will have leverage. So I can't do the maths in my head. Let's not try and do public maths, but you would have to do the calculation on if the property grew by 5% a year, and you had a 50% LVR on the property because it's grown, it's got a bunch of equity in it, then in principle you would be getting a 10% increase on your capital each year, roughly. If I think I've done that maths correct, right? If you've got a 5% growth on a 50% LVR, then you double the growth rate to get your return on invested capital. So you would have something like a 10% return in that scenario. So you sort of got to do a calculation based on what would be the top line growth forecast for the property. How does that translate to a return on invested capital as it sits within the leverage structure on the property? Then how would that be? How would that be better or worse than selling the property? You've got selling costs, including CGT and all that kind of stuff, paying back the PPOR, taking all of that capital out, getting the gain on the fact that the interest expense is tax deductible, and then also going and buying another investment property. So I think there could be a good argument for it, because if the function is pay down one loan, turn that into a tax deductible expense, then take that capital out and go buy another investment property, potentially in a higher growth location anyway, then it could be a strong argument for it. But you really got to think about that from an ROI basis.
Yeah, I think there's also the element of timing for the property that you're selling, right? Like, is it the right time to be selling the asset that you hold? Like, if you're thinking about selling the investment property, is it the right time in that particular market to sell that property? And does that suit your strategy? Like, did you buy it to be a long-term buy and hold? Are you just getting maybe cold feet or hot feet with the current market and thinking now's a good time to sell? Thinking through, like, zooming out and reviewing your whole strategy and the timing of where that asset is something to keep in mind as well, I think.
Yeah, 100%. And if you've got questions about that, if you're watching this or listening to this and you're like, I need help to work that out, then reach out to us. We can probably help you out. We'll probably give you some guidance and advice on that. How should people do that, Gabby? Should they send us an email? Should they hit a link somewhere? Because it's a really good question.
The links.
Yeah.
Do I have the link?
It's a really good question. And if you're sitting out there think so. Matt is a client, so we're going to do this for Matt anyway. We'll do a review and we'll provide advice and guidance on whether Matt should or should not consider selling some of those properties based on market conditions and real estate market intelligence, which we're excellent at. But if you're not yet a client, but you still want some help and support, reach out to us. We'll see if we can help you as well. Because the most important thing is make sure you've got a plan and also make sure you've got the right intelligence in the market to be able to make those decisions. And so if we can help you in some way to make a better, more informed, more intelligent property investing decision, then we absolutely will do our darndest to do that. So actually just quickly, what is, like, if they just wanted to send us an email, if there is no link, it's like, what is that, like podcast@dashdot.com.au or something?
That's it.
Bingo. How good, right? So if you're not yet a client, but you've got some properties and you're trying to work out whether or not you should sell, and you need some help, or you need some advice, shoot us an email, podcast@dashdot.com.au, and we'll do our best to kind of give you some guidance on that and help you understand what to do with no obligation and no cost. All right. So just as our service to you. Cool.
Perfect. Cool. Now, we do have questions coming through in the chat, which is awesome. I did just want to pull up a question from Katie because it is similar to the last one. I just wanted to make sure that we haven't missed anything. So from Katie, does paying off your PPR loan make a significant difference when it comes to borrowing capacity? We're in a position where we could sell one investment property and pay off our PPR loan completely. This would mean $350 less cash flow per week, as we wouldn't have that rental income. I'd love to hear your general thoughts about this topic, Callum.
Yeah, again, great question. I suppose the first thing I'd preface this with is, what we just mentioned about whether that's actually the best decision with your long-term plan and the ROI that you're expecting. But if we think about just on a borrowing capacity perspective, yes, your borrowing capacity is greater without an owner-occupied debt. You can think about that owner-occupied debt. It's like a dead weight on your borrowing power. It's just an expense. It doesn't bring any income to the situation. So in theory, if you sold the investment property, paid out your home loan, and then reborrowed that for some investment purpose, yes, your borrowing power is going to increase substantially. But it's about whether it actually positions you into a better ROI from doing it that you'd most want to think about.
And Katie, I think, is a client of ours as well. So I would place a pretty good bet that we would be able to assist with getting a decent ROI. Ooh, Goose, you've lost audio. Or is that me?
Oh, that's because I hit the mute button. So
that would be
why. So Callum, just quickly, in this scenario, is this a scenario that you could help someone kind of like model out? Like if they're in a position where you could go, hey, what would your borrowing capacity be with or without this scenario? Because one of the considerations here is if Katie sells the property, there's $350 a week less income that's going on the income side of the statement. So on that basis, that's gonna have an impact on the borrowing. So you could do an assessment on the as is versus that theoretical scenario, and then work out what's going to be better straight off the bat, right?
Well, I mean, in theory, she'd be replacing this with another investment property. So the two rental incomes are probably going to cancel each other out, assuming like for like. But yeah, absolutely. Part of our services will model out, I should say, multiple property purchases, different asset prices, different rental yields to try and arrive at something that ultimately meets the ROI goal.
So, Gabby, have we got the DDF link in the episode description?
Yeah.
Okay, because every episode we've done so far, someone's had a finance question and they've needed to speak with Dashdot Finance. So we have a link in the description. Just go down under there and find a link, and you'll be able to book in with Dashdot Finance. And if you want to get a borrowing capacity assessment, if you want to get a finance strategy so that you can work out what the best way forward is going to be for you and what you can do and where the best lenders are and all of that kind of stuff, book in with Dashdot Finance for a free consultation to work that out and see what your options are. Because this is a great scenario where you can do some scenario calculations and then go, okay, look, should we or should we not do that? Should we not pay off the PPR and just go buy another investment property, maybe refinance the equity out of the existing investment property and just go again without paying it off? Or is it going to be better to sell one down, pay that, split the loan, debt recycle, buy another one? This is all stuff that Dashdot Finance can help you with, and there's no cost to that at all. So if you do have a question like that and you do want help, that's the best place to go, because the reason Callum came on board with Dashdot is because he and his team are property investment specialists. That's the bread and butter of what they do. So they're the best people to ask if you need help in this area. So make sure you hit that up. Where are we going next, Gabby?
Cool. Well, two key topics we still want to make sure that we're hitting, as well as questions. So I'm going to try and pull out questions that are related, but let's hit trusts, because I'm thinking through these two topics, trusts and SMSFs. the last couple of weeks have come through in the chat that people do have questions about. So if you have questions, chuck them in the chat as well. Question from Braden. Let me just get it up. Okay. Can you explain the limitations with negative gearing in trusts?
That is a great question, Braden. I think one that's probably commonly not understood very well as well. So if you were to think of the concept of negative gearing, it's a bit of a buzzword really, but in plain terms, what negative gearing is it's you claiming a tax deduction for the interest that you paid for some investment, whether that's a property that you own in your personal name, which is kind of the connotation of negative gearing, or if you have a business and you have a truck that's got a loan, you're claiming the interest on that truck. It's just the same concept. The interest is tax deductible. Now, the difference between whether that's owned in personal name or whether that's owned in a trust is that the interest in the trust is only deductible towards the income that that trust earns. So the challenge that a lot of people have with trust is that the time horizon for you to be able to claim those tax deductions can be a lot longer than if it's in your personal name. Because if it's in your personal name, you do your tax return at the end of the year, you claim the interest deductions, your negative gearing, and you receive the benefit then. Now, what happens with the trust is it's still accruing all those interest deductions through time. They're sitting there adding up in the trust effectively. And then at some stage in the future, when that trust does start to earn some income or you sell that property, you're going to claim the tax deductions at that point in time. So there's some other nuances to do with land tax and other things, which you definitely need to speak to an accountant about before you decide to do something like this. But on face value, the interest in your personal name versus the interest in a trust is no more or less tax deductible. It's just when and where you're able to claim it, that is the difference.
So the way to think about that is when you're investing in a trust, you're effectively investing in a business structure, right? And if a business loses money, if a business is not profitable in 1 year, then you effectively get a tax credit. So let's say the business loses $100,000, then that's $100,000 loss you can claim, and then next year you make a whole bunch of profit. You can claim that loss against your profit on future profits. So you kind of, as opposed to getting the income back in a form of negative gearing, which you mentioned, Callum, you can do that at the end of the financial year. There's also ways that you can do that. If you're doing it in your personal name, you can get it back on a kind of like fortnightly or regular basis if you do some kind of, I don't know, wacky kind of, there's a wacky way you could do that.
Tax variation.
Tax variation. There we go. That's the wackiness I was thinking of.
So wacky.
But so the negative gearing considerations in a trust, you don't lose the benefit of the loss, right? You actually just stockpile it until you make a profit, and then you can use those losses against the profits that you make, so you don't lose them. One thing that I think is interesting about this as well is there's a propensity that I've seen for accountants to, and by the way, big precursor, not tax advice. You know, we can't provide advice on structures and tax and all that kind of stuff, but this is more of an opinion piece or a thought piece. There's a lot of accountants out there that say that property investors shouldn't set up trusts shouldn't set up trusts to invest in until they're like serious about property investing. But the problem that I see is property investors go, okay, that's fine. I'll just start buying in my personal name. But then when they actually become successful, which is actually what Dashdot clients do, right? It's like they end up, they get past one property. You know, they don't just buy one property and sit there. They buy 2, 3, 4, 5, 6. They 100% of the time they've looked back and gone, if I'd known what I'd known now, I never would have bought that first property in my personal name. I would have just bought it in the trust in the first place. Do you have any kind of thoughts on that? Without not financial advice, but do you have any thoughts on that?
It's very true, and it's something that's a clear thought tree at the start. And as much as you can try and reinforce that to someone, hey, you know, this is a strategy that could be aligned with you borrowing more money in the future and purchasing more properties. It's challenging when the consumer themselves doesn't know that's ultimately where they're going. And I think the other part which is difficult with that is, and this is no knock on accountants, but the majority of accountants aren't property investors, and they're not, they don't have clients that are serious property investors. So the accountant's primary job is to come at it from a tax angle and say to the client, oh, well, you can't claim you can't claim this deduction against your income. I don't think it's for you. But they're missing the loss of opportunity cost of ultimately running out of borrowing power. So you're right, it's a very difficult conversation because a lot of people don't actually know where they're going. And that's why as a business, we work with a group of professional partners that really understand the greater strategy that comes with it, especially from a borrowing power perspective. And at some point in time, there is going to be a loss of opportunity cost, which will be you not being able to borrow any more money, perhaps having to sell something in your personal name to move ahead. And it's something that, like you said there, every property investor eventually like, oh, geez, I should have done this 4 years ago. But how we get there, it's difficult.
Can you explain how investing in trusts can be beneficial? Like you just mentioned, you kind of like touched on it there, that there's an impact on borrowing power if you don't invest in trusts and stuff. Can you? I obviously understand the concept, but a lot of people don't. Can you explain that in layman's terms? How does that work? And again, speak to your own accountant or speak to an accountant that's a property investment specialist is probably the best way to think about it. Or get in contact with us. He'll hook you up with the right people. But just to kind of explain that, like how and why should someone consider investing in a trust from the perspective of how it impacts borrowing capacity?
Yeah, it's a great thought experiment. So the way that I usually explain it is, let's imagine we have hypothetical property that is producing positive cash flow. So through time, it starts to produce great rental yields. Perhaps the debt's been reduced a little bit, and it is in real terms putting money in your pocket at the end of every month. Now, if we think about that property being owned in your personal name, even though that it is actually putting money in your pocket every month, by a full bank assessment, it's actually not. So by the time they take 20% off the rental income, by the time they add 3% to the interest rate, that cash flow positive property is taking money out of your pocket in the bank's opinion. So what happens is it doesn't really matter how many positively geared properties you own in your personal name, you'll ultimately just run out of borrowing power. Now, if we think about that same hypothetical property that is owned in a trust, what happens in that circumstance is there's a whole range of lenders out there where, provided that we can verify that that particular trust is able to look after itself, i.e. that it's producing positive cash flow, it's meeting the repayments on the loan on an interest-only basis, it's paying the council rates, all that sort of stuff. There are lenders out there that will just say, okay, well, that debt doesn't belong to you personally, Goose. It belongs to this trust over here. We can verify that it's able to meet its own commitments, so we won't include it in our borrowing power assessment at all. So you can think about it like being able to hit the reset button on your borrowing power, provided that it's cash flow positive and it's not owned in your personal name. And the thing with the cash flow positive side of things too is there's even lenders that have some flexibility on this and don't even actually verify if it's cash flow positive on a full basis. So it's a strategy that any property portfolio you will see, unless they're like a doctor or someone that's earning $1 million a year on a PAYG basis, large scale portfolios are ultimately almost always built in family trusts. Now, obviously, it's there's other aspects you need to consider, which your accountant can help you with, but that's just the crux of it.
Super interesting, right? Because like in that scenario, in the first instance, the purchase of the property is going to be based on your ability to borrow, right? So let's say you've got $1 million borrowing capacity and you want to go buy a property. So in the first instance, the acquisition of that property and that loan will be based on you as an individual. But post hoc, once that property can prove that it can stand on its own 2 feet, or by the way, actually, let me reframe that trust can prove that it can stand on its own 2 feet. Because sometimes I know that the way that some people manage this is they'll have like one negatively geared residential property and then one high cash flow commercial property, so that the trust ends up in a positive cash flow situation. As long as that trust can stand on its own 2 feet, then effectively the debt, whatever debt's associated with those properties is over there, and you get your $1 million borrowing capacity back. You're back to square one. So each time you sort of like, you start, you spawn, you kind of put it over there, lock it up, come back, square away, and go again. So you get to keep going and going and going and going. And that it really is probably like the only way to get beyond, let's say, 4 or 5 properties, unless you're on a stupidly high income, right?
Correct. Yeah. And I think the decision tree with that too is, and again, going back to what you said before, sometimes people don't know this, but if you're just, let's just call you average John and Jenny Smith and your firm, I just want to buy 1 or 2 investment properties. That's it. That's going to get us to our retirement goal. It's like, this strategy with trust, probably not for you, but anything outside of that is going to be something that you probably wish that you had have thought about before you get too deep into your journey.
Yeah, but it's a real double-edged sword there, because 71% of property investors never get past the first property, right? 90% never get past the second property. And why? It's because they get stuck. They get stuck on things like borrowing capacity, right? And they get stuck on things like, and so you could argue that the reason, so you're right in that if someone's very specific goal is they never want to own more than, say, 2 properties, like the hard line, we never want to go past 2 properties. Okay, fine, whatever, right? Probably don't think about that. But I would also argue that a very large part of the reason that most people don't get past 2 properties, even if they want to, is because they don't have the right finance and structuring strategy in place from the get-go. And, then they're going to unpack and unwind that, and it gets too complicated and too hard. And so if people just had the right strategy to begin with, then perhaps they wouldn't get stuck in the first place.
Definitely. Yeah.
Sweet.
Yeah. It's like Peter's just added to the chat now. We found trusts great for extending our borrowing capacity, but they did come with a higher interest rate, around 1% higher than if we could borrow it in a personal name. But the point being, has been beneficial for extending borrowing capacity, like we've been saying.
So I know that this is not the point, and I'm not trying to be combative or whatever here either, but the whole kind of like it's 1% higher, yes, sure, but if you can get a 300% return on invested capital in 3 years or something like that, then does 1% of an increase in borrowing cost, does that even matter? And if it's the difference between you being able to buy 2 properties or 5 properties or 8 properties, right? then the compound effect of that is wild. It's kind of, when you get this right, and this is the most interesting thing about real estate, because Gabby and I are both invested in other asset classes and interested in other stuff. And one of the big things I hear, like from Bitcoin people, right, is that real estate's slow and it sucks and it only goes up by 7% a year. But look at Bitcoin, it goes up by like 60% a year. Woo! It's like, yeah, but real estate has an infinite money glitch, right? Because of the nature of it being quite stable, you can put a deposit in, it can grow, you can refinance that equity out, you can go buy another property, and you can keep doing that. And you can end up getting thousands and thousands of % return on invested capital in a fairly short period of time. And I think that's the bit that people are missing. And so your ability to amplify that using these kind of things, it's like, all right, so if it costs you 3% more or 5% more or 10% more to use a trust strategy, but you could grow your property 10x more, get a 10,000% return on invested capital, would it even matter? I think that's the kind of thing that people get. And so Peter's here is 100% agreeing with that statement. So I know that Peter's on the same page here, but for people listening, they get stuck on these kind of small numbers, like interest rates went up by 1%, or yada yada, or this thing costs me an extra, like having a trust or whatever is going to cost me an extra $1,500 a year in accounting expenses, therefore I won't do it. It's like, but you can make like 100 or 200 or 300 grand a year if you just had the right structure, right? It's like it's crazy.
It's just the cost of doing business. It's like if you decided to sell, I don't know, fruit out of the back of your car versus selling fruit at a commercial scale, there's going to be an increase in cost somewhere, but ultimately you're going to make more returns at the end of it.
It's about accepting there's always costs, right? And I think like in terms of knowing where your constraint is in the current situation, and being able to realize that there's going to be a cost to help me kind of push through that constraint in some way, you're not going to get, there's a reason that not everyone invests in property or invests at all, because they're not willing to kind of invest in these costs to help move them forward. So it's thinking that through.
Yeah, it's funny. And then there's other people who go and pay a hedge fund 2 and 20 to go and invest their capital and they beat the hurdle rate of the S&P 500, which is, for those who don't understand what I just said, the like a hedge fund or a managed fund or active management fund will typically charge a 2% management fee on your capital. Then after they've beat the hurdle rate, they'll take 20% of whatever is above the hurdle rate. And like billionaires do that. You know what I mean? And that just seems wild to me. And then you've got retail investors who are like, oh well, hang on a second, this is like the interest rates are 1% higher, therefore I won't invest. It's like, whoa, mad. All right, what else have we got, Gabby?
Got one more just on trusts. One sec. So theoretically, the trust makes no money until the sale of the asset. All the losses could be claimed then.
I mean, in theory, yes, or it could be the case that through time, the rental yield on your property increases. Maybe you pay down the debt a little bit and it starts producing positive rental income. So could be a whole range of circumstances that result in that trust eventually making money. It's just more so in the current interest rate environment, when you tend to purchase a property, especially if you're taking 100% gearing, or even if you're only putting a 15% deposit in, that property is very likely to be negative cash flow. So initially, at least, that trust is likely to have losses sitting there accruing through the first few years.
Yeah, there are things as well, and speak to your accountant, but you can actually defer some of the losses as well. So there are things that you can do within the accounting structure to either amortize some of the losses or defer some of the losses, or you can never escape them, right? It's not, you're not doing anything, but you can adjust the timing of when those losses are accounted for as well. And that can also help you with whether or not your trust in that year is reporting a profit or a loss, which can then again impact your borrowing capacity as you think about the kind of debt siloing nature of trust as well. So
awesome. Cool. SMSFs. So we do have a question here, but similarly to what Goose asked about, how does it generally work? Because I think a lot of people have been sending in questions related to SMSFs. Why would somebody benefit from setting up and investing in an SMSF?
It sounds daunting to some people. I think it's long too. It's like, ooh, SMSF, ooh. But think about it like this. So you have your standard superannuation fund. Let's say it's a retailer industry fund. Your money's sitting with Host Plus, and you decide in consultation with your accountant, your financial planner, okay, I want to take that cash that's sitting in my Host Plus account and put it in Gabby's self-managed super fund. So what that allows you to do then is to use that super balance that you had. You might even not transfer all of it. Let's say it's half of the Host Plus fund you put in the self-managed super fund. What happens now is you can get access to debt or access to leverage to be able to go out there and purchase property, which is something that you can't do in a normal superannuation fund. Now, there's other stuff that you can do with a self-managed super fund, commercial property, business acquisition, stuff like that. But if we talk purely about residential property, what it allows you to do is use that superannuation fund cash that you have as the deposit on an investment property, and then go out there and purchase an investment property. Now, what actually allows you to get that loan, and where the real value in a self-managed super fund from a borrowing power perspective comes from, is that lenders are only looking at what's going on inside that super fund in isolation. Because let's imagine that you're working a job. At the end of every month, your employer pays your 11.5% super contributions. They go into your super fund. So it's a very simple equation for the lender to work out, okay, how much can this super fund borrow? We just have the super contributions coming in. We have the rental income that this property is going to receive, and maybe we have some investment returns that the other assets in this fund is going to generate. And it just becomes this simple equation for them to work out, okay, yes, you can go out there and purchase property of value X with as much as an 80% loan for you to invest, or your super fund to invest on your behalf as the fund member.
So how does somebody in that situation, let's say that they've bought an asset and it's grown a lot in a couple of years, how does somebody benefit from that? Sure, like that, I believe they need to wait until retirement to benefit from that, right? Or can they benefit along the way?
Yeah, so that's I guess some people's apprehension with super fund lending is that the time scale is extended. You get the most benefits from it if you decide to sell that asset after you're a preservation age. But there are people that decide to use their super fund on more of a flipping strategy, because it can generally be more tax effective, even if you decide to sell assets within inside the super fund before you retire. Because the challenge you have with self-managed super fund properties is, if let's say you buy this property and it increases in value quite substantially, you can't do an equity release against the property owned in a super fund. So you can't say, oh, okay, this property's gone up in value 400K, I'm going to increase the loan, use that as a deposit on another property. It's not possible. So oftentimes you'll have people, the decision tree might be at that point in time, oh, maybe we sell this property, we'll recoup the gain there, and then maybe we use that for a deposit on a bigger or a better property in the super fund, maybe a commercial property even. Can
you get interest-only loans in SMSFs?
Yeah.
Okay, and so, but you're saying you can't refinance, you can't refinance the loan, or you just can't redraw the equity?
You can refinance. That's another thing that the major banks used to offer self-managed super fund loans. So there's a whole heap of consumers out there on these super expensive major bank SMSF loans. So if that's you really should consider refinancing it. You can refinance it just on a dollar for dollar basis, including any fees, but you can't borrow any extra cash.
Yeah. But so kind of like what I'm thinking there is, if you can't refinance the equity out, then one way that you could preserve the benefit of the leverage that you have on the asset is to only pay interest only. So if you could get an interest only loan and then refinance to another interest only loan and refinance to another interest only loan and continue to do that over time, then you would at least maximize the leverage benefit that you get on that asset over time as well, because you're not just inadvertently paying down the principal to zero over time. So that would be one way that you could maximize the returns on that asset as well. Does that make sense?
Yeah, I mean, in theory, you could do that. There's a whole bunch of lenders that will allow interest-only lending in self-managed super fund.
Yeah, interesting. Yeah, it's quite funny because the way you kind of started that little soliloquy earlier, it's like I think a lot of people get daunted by SMSFs. You know, they're like, "Oh my god, it's this crazy thing." And we get asked all the time, "Can you buy properties in SMSFs?" It's like, yeah, the only difference. I mean, I'll circle back. I'll clarify this in a little bit, but the only difference is what name are we putting on the contract? like what is the name of your trust or your bare trust or your, whatever that is. Yeah. Who is the purchasing entity? Now, in practice, though, you do need to be careful around what types of assets you put into your SMSF, right, Callum? Like, because, for example, you can't do improvements, or if you do improvements, you can't claim any benefits on that. Can you kind of clarify how that works as it relates to improvements on the properties in SMSFs to the best of your knowledge? And if it's outside of your scope, if it's more of a tax question or whatever, then you can just tell me to bugger off or whatever. But it's an interesting consideration to understand, like, what are the restrictions or what are the limitations? And then if it is negative cash flow, how does that impact? Is it just like, if it's negative cash flow by $1,000 a month and my super contributions are $1,500 a month, then great, my super contributions cover the negative cash flow, and it's just as simple as that? Or is there anything else we need to think about there?
Yeah, so I mean, in terms of the improvement side of things, and again, general advice disclaimer here. This is something you need to speak to an accountant or a financial planner about. But the rule of thumb is that you can't do improvements to the property, that you're able to do maintenance on the property. But things like property developments or building a townhouse out the back or things like that, those are the types of things people get themselves into hot water doing in a self-managed super fund. So you really want to think about it as more of a set and forget type asset. And I think the other thing that's important to consider too is it's probably different to buying something in a trust or in personal name. It is more regulated. So that's really the position that your financial planner and your accountant helps you to arrive at in determining that this is the best activity that this superannuation fund should be doing for this super fund to earn a return.
Interesting. Yeah. So there's a few good questions coming into the chat around this. So maybe we'll hit some of those up. So Peter Burns asked, what is the minimum LVR in SMSFs? What's the minimum LVR, and what is considered a great rate at the moment?
Well, I'm assuming, Peter, that you meant maximum LVR. Minimum LVR would probably be 0.001, but
maximum LVR. Yeah. What's the least amount of money that Peter needs to put in order to be able to buy a property? Yeah.
You can do 80% LVR in an SMSF, both for residential and for commercial properties. There's actually a lender out there doing 90% LVR for strong self-managed super funds at the moment.
What constitutes a strong self-managed super fund?
So it's based off of what they would call liquidity tests. So lenders will rate a super fund based off of what other assets are left in that fund after it's gone and purchased this property. And also,
so if you own $1 million of shares or something in the SMSF, and they could go, okay, well, we could liquidate if the shit hits the fan, we could go liquidate those, and okay, so it's kind of like a net assets test.
Yeah. And then a good rate depends on the LVR. The cheapest you'll get for a self-managed super fund at low LVRs is going to be 7.1 to 7.2% for resi. Commercial, somewhere around 8% is about the cheapest that you'll get. And then sort of want to scale up from there depending on risk profile, LVR, and so forth.
Nice. Now, we've got someone in here, Miss Truth Bomb, who's asked a bunch of questions, right, which is awesome, and we love that. So let's try and hit it. Let's try and hit a few of them because they are related to this as well. There's one that's not related. But let's just go from the top. So she's asked first, what age can you take a loan out at or until? Basically, like how old? What's the maximum age that you can take out a mortgage?
I just had this image of someone taking their 4-year-old kid down to the bank and putting the pen in their hand.
Well, funny you say that. Actually, somebody did send in a question asking. They said, "How how do we think about investment strategies for our children? And when I first read that, I was like, okay, that's super interesting. Like the kids must be like in their 20s or whatever. And they said, but their kid is 3.5 years old. They're like, yeah, a portion. So the kid is saving. That kid needs to put his money into good investments. What do we do for a 3.5-year-old? I'm like, oh, that's what's the right investment strategy for 3.5-year-old? I think that I think it might be what's the maximum age that you can take a loan out until.
Yeah. Well, the minimum age is pretty straightforward. You have to be 18. But the maximum age, I've actually written a loan for a 91-year-old before on a 30-year loan term. So the
Really?
So the thing with the age situation, which is, it's probably an interesting talking point, because banks and lenders used to be a lot more ageist, if that's a word. A few years ago, they would be very cautious on, giving 30-year loan terms to people that were even only 55 years old. But essentially now it's based on your asset position. So let's imagine that you're 75 years old and you've got $5 million worth of investment assets at 50% LVR, and you want to refinance one of them to a 30-year loan term. Like, obviously you're not going to be around at the end of the loan term, but there's plenty of lenders out there that are happy to do it. So there isn't really a maximum age. It's really about what banks would call exit strategy. So that's them working out, okay, well, how is this person going to exit from this loan?
Nice. So the next question is, I think if I read this correctly, if you're on a pension, there we go. Yeah. I think it's if you're on a pension, can you use that money to finance a new loan?
Yeah, so there's lots of different types of pension. So if we're talking about an aged care pension, there are some lenders that will use this. But then, if we're talking about military pensions or some sort of defined benefit super scheme pension, they're absolutely, if it can be verified that you're going to receive it lifelong, effectively, then most lenders will actually deem, outside of an aged care pension, most lenders will deem a pension to be one of the safest income streams for them to fund a loan against, because you're not even in control of receiving it.
Nice. Okay, so it is possible, but there's probably going to be some restrictions depending on obviously how big the pension is, right?
Yeah.
At what age can you do a flipping At what age can you do a flipping strategy in an SMSF? So are they going to? I think that kind of relates back to how old can you be to get the loan? You do it to flip it. If you got your SMSF, let's assume you're not old enough to to access that yet, and so you want to sell a property down in an SMSF and you want to get another loan to buy one. Is there going to be an age limit, or is it sort of going to be? It's sort of, we've sort of answered that previously, but is it going to be difficult? Let's say someone's 60, they can't access their pension yet. They're 60 years old. Are they going to be able to get another loan pretty easily?
Well, look, provided they've got the income to get the loan, getting the loan is fine. I think maybe what this question might be talking about here is some of the tax aspects and whether it makes sense to do it based off of how old you are in the tax bracket. So it's really a question you need to speak to an accountant about to understand, okay, at what age would I get what tax benefit from doing something in my super fund?
Okay, cool. I hope we've answered that.
Awesome.
Sweet. Nice. We've got a lot of good questions coming through. So if you have any more questions, make sure you drop them in the chat as well, and we will try to get to them. We are getting closer towards the end of today's episode. Gabby, is there any other questions that people have sent in during the week or anything that we need to get to?
Not during the week, no. I was just thinking, is there a particular reason why more people are talking about SMSF lending lately? Like, has something changed, or is it purely people are just trying to find different ways to unlock borrowing capacity?
Yeah, I think it's really a function of people having constrained borrowing power at the moment. Obviously, interest rates are at an all-time high, and they're a strategy where, let's say you've completely exhausted all the options that you have in personal name and you've been making contributions to a super fund, you will have borrowing power. So I would say that they were something that was super common maybe 10 years ago, and we had the sort of off the plan boom. You'd have a lot of agencies out there selling off the plan properties in super funds. And I think it probably got a bit of a bad name for a while there, but now it's probably coming more into vogue just from people with borrowing power constraints.
So maybe it might shift back. I know we're saying that interest rate drops initially, like it'll take a little while until people's borrowing power comes back up, but maybe throughout the year there'll be less interest in SMSFs, maybe.
Yeah, I'd imagine that's the case. If we end up in a interest rate environment, like what Goose was suggesting, the cash rate might end up. I'd imagine we'd see less inquiry for it.
Yeah, awesome.
Yeah, it seems to be, in my experience, it seems to be the thing that people look at once they've exhausted their opportunities in their own personal name. It's kind of like,
Yeah.
Because it is a little bit more complicated. There's more paperwork. There's a bit more friction. It's kind of like what I personally have tended to see from an investment side is that people go, all right, let's just go buy property. Okay, they've found an edge somewhere. All right, what other options have I got now? All right, SMSF, right? Let's go do that. And then by the time they've done that, then, maybe they've paid down some debt, or maybe their income has gone up, or maybe something else has changed. They've freed up some of their borrowing capacity on their personal name, that they go back and then they buy more properties in their personal name. So it tends to sort of be the progression that people go there once they've done everything they can do outside of SMSF. Tends to be what I see. So I think I'd second Callum's point of view that probably people are looking at it because they're just looking at what options they've got to utilize their capital. The other side of the coin is, I think that if you surveyed most people in Australia and said, are you happy with the returns you're getting in your super fund? Are you happy with your returns and fees that you're getting in your super fund? Would you prefer to be in control of your own money? I think most people would say, I would prefer to be in control of my own money. Thanks. Like personally, I'm like anti-super. I understand why we have it. I understand not everyone is, financially educated enough or financially responsible enough to be able to take. I understand why we have it. So don't take that in the wrong way. But for me, I'm like, I'm like, no. Like, why would I want to have my money in a super fund? I can do way better than that by myself. Just give me my money and let me go and invest it. Right. So I think people start to look at that and go, well, am I better off investing the money in my way? Can I get a better return than, Host Plus or something like that? And the answer is probably yes, particularly if you're getting leverage on real estate, and particularly if you're buying a good asset. Because if you buy a property that's going up, that goes up 20 or 30 or 40% in the three or 4 year period, the friction that you will have experienced in your SMSF versus the returns you're going to get, you're going to massively outperform something like Host Plus, right? Which is getting a pretty kind of mark to market type return, or a pretty like kind of basic hurdle rate return. So I think people are looking at it now as well and going, okay, do I think I can do better than that?
Yeah, there's also a lot more awareness, I think, these days of the ethics around super funds as well, with people kind of getting more aware of what the super fund that I have, most people have one super fund that when they get their first hospo job, they set that up and then their 10, 11% just goes in there every fortnight, and not really looking into how is that fund using my money, my retirement money? How is that fund using that? Where are they investing? Because that's all that this is, right? It's like they're a fund, they invest in certain things, and there's more awareness around what kinds of industries and projects and other companies that the funds are investing in. And so I think a lot of people starting to like that idea of having more control over where their investment goes versus just going, here you go, Host Plus or Australian Super or whatever. You can invest in whatever things you want to invest in. I think that's just growing more recently.
Definitely.
Yeah, 100%. So we've got another great question that's come in. I have an SMSF and own one property under it. I would like to accumulate more assets. It looks like I have to sell if I want to buy more as I don't have a deposit. Is that the common strategy?
Correct. Yeah, unless you're in a position where perhaps you can add some more to the fund, maybe, and again, you can speak to your financial planner about this. Maybe you're in a position where you can make an additional contribution to the fund to increase the balance. So then you've got another deposit available for another theoretical property that you could borrow for. But in terms of being able to access the equity that you have in that particular asset, unfortunately, yes, it would be a sale. You can't refinance it.
Nice. Callum, I've got a question for you. As we are starting to get towards the end of the episode, what advice would you have for people thinking about property investing in 2025, and specifically as it relates to finance and structure? Like, do you have any advice for people as they go into this year?
Yeah, well, I think mirroring the first point that we mentioned would be to pay almost no attention to the interest rates in terms of you determining when and where you should be investing. It's really about you having the available capital to do it, and also having a firm strategy in mind in terms of where you're going to invest and what outcome you're looking for from it. That'll be the first thing. The second thing that I would say is, which I think is certainly becoming commonplace amongst the younger generation now, is really questioning some of the beliefs of our parents' generation around, what you should be purchasing first. Most circumstances now, it really just doesn't make sense for someone to be out there thinking about buying an owner-occupied property, especially if you're living in a big city and you're not prepared to compromise on where you want to live. Would be the second thing. And the third thing would be really just take advantage of the lending conditions that we have at the moment that are really promoting low deposits on investment property purchases. There's never been a time where you could purchase an investment property with a smaller deposit than right now. You've got lenders like ANZ at 97% LVR, Resimac at 95, CBA at 95.
Really, for investment properties?
For investment properties. So they've created these products really to meet that demand in the market, which is the rent vesting crowd. And if you compare that versus my perspective, depending on your circumstances, an owner-occupied property is like a 30-year noose around your neck for a lot of people. If you're a young person and you've got the means to even save just a 10% deposit, you can be market ready, with someone like ANZ today, effectively, to get into the market.
Yeah, 100%, particularly if you live in a city, right? So like an easy, just to kind of touch on that point about rent vesting, an easy way to kind of do a little bit of a litmus test of like, should you buy or should you rent is it going to be cheaper for you to rent than it is going to be for you to pay the mortgage? And in most cases, when you're living in a capital city, it's going to be cheaper for you to rent than it is going to be for you to pay a mortgage on a property. And so not only are you going to end up financially worse off on a week-to-week cash flow basis, you're also going to completely, nuke your borrowing capacity because you've got non-income producing debt, potentially, $1 million or 800 grand or 500 grand, whatever the number is of non-income producing debt, which is going to significantly inhibit your ability to be able to make any kind of progress on your financial future or buy any kind of investment properties versus flipping it around the other way. And maybe you're going to pay, I don't know, less, we'll just call it less in rent than you would pay on a mortgage repayment. But you also then can get the debt, which is income producing debt, which can effectively get a lot of that borrowing power back because you've got income producing, you've got an income that's being produced against that debt. So from a financial returns perspective, it doesn't make, in my opinion, it doesn't make any sense for people to go out there thinking about buying their own home. Now, that's from a financial returns perspective. And so this is always the caveat I put on this because a lot of people can kind of be like, but it's more important for me to own a home than it is for me to build wealth. And that's fine. We actually had someone on the Dashdot team who got a portfolio growth plan. They've been on the team for 4 years now, something like that, or whatever, three years. A younger individual got a portfolio growth plan, had a clear pathway. This is how you can achieve your financial goals. Looked at it, said that looks great, but you know what? My values are such that it is more important for me to buy a family home, to have my kids and all that kind of stuff in a family home than it is for me to go and progress on this right now. So that's the choice I'm going to make. And if that's your decision, if that's the basis of how you make that decision, rock and roll, have at it. Like there's nothing like people say that investing shouldn't be emotionally driven, but it absolutely is. I mean, you're investing because your life depends on it. But the same thing goes. If it's going to be more emotionally enriching to you to go and buy a home, just understand the price that you will pay is you will limit your ability to progress your wealth journey. And there's no wrong answer. But if you want to progress your wealth journey faster and better and achieve financial freedom faster and better and easier, then it probably makes no sense to go buy, unless you are like exorbitantly wealthy, then it's going to make no sense to go and buy a home to live in the first instance. You're far better off using real estate as a lever to grow your wealth, build your equity, get yourself to a point where you can eventually then go and buy the home that you want. For most people, getting into the market, and we speak to a lot of people who are just getting into the market for the first time, or maybe they own one property or whatever, they have, 100, 150 grand saved up, but maybe they want to buy a dream home of, or maybe it's not even like some kind of fancy, lavish mansion-like dream home, but let's just say they want to buy a property in Sydney somewhere so they can live close to their family. Well, let's say the property is 1.2 million. If you need 20% in terms of like deposit plus costs and all of that kind of stuff to get into that property, you look at it 600 grand. So if you're saving, let's say $2,000 a month, or let's say you're saving $3,000 a month, 36 grand a year, and you've got $150,000 of savings, how long is it going to take you to get from $150,000 to $600,000? And then how much is that $1.2 million property going to be worth by the time you get there? It's going to be worth more than that. You're never going to save your way to get into that property. So the only viable solution is to go and seek a way to accelerate your capital to then go buy the dream home later on. So What most people want is they want a roof over their head. They want a safe place for their family. They want to be financially independent so they can do what they want when they want with who they want. The pathway to get there is not by starting with buying a home, right? Even though that maybe is the goal, is to get a home. You don't start there. Just in the same way that most people want to create, they want to create residual income, or they want to replace their income through property. You don't achieve that by going and buying cash flow properties from day one. That actually usually doesn't make any sense. It's usually going to truncate your ability because you'll get stuck and you actually won't get to your goals. So the thing you have to kind of take a strategic path to get to these outcomes, which is my rant over. Thank you for coming to my TED Talk.
Thank you. We are nearly at time. I just remembered a topic that I wanted to touch on, and I'm wondering how far this will go. But non-bank lenders. So I think, obviously, when you're starting out in property, generally it's like personal name is how people just think about it. What's my own individual capacity to borrow right now? And generally starting at the top tier lenders like Big Four, right? And then as you progress, you get more advanced, you get more sophisticated, you think about different structures, but then you also kind of work through the tiers of lenders. Why are people scared of non-bank lenders?
Really good question. So if you're watching this and you've been offered a non-bank lender by your broker, I want you to just give yourself a pat on the back. Actually give yourself a pat on the back, because if you're being offered a non-bank lender, it means that you have had some level of success in property investment generally. Because what happens is you end up with non-bank lenders where you don't generally have the borrowing power to proceed with the banks. So the way that I explain this to people is, people tend to think of banks as being much more than just a service, but a bank or a lender is just a service that gives you money for you to buy that asset. So let's say that you're paying your insurance each month and you don't really care whether you're paying your insurance to Amy or Budget or whoever. It's just that direct debit that comes out of your bank every month. Now, using a non-bank lender is exactly the same. They're going to lend you the money, and it might be at a slightly higher interest rate than you're getting from the banks. But at the end of the day, they're just the tool that allows you to keep progressing and growing your property portfolio. And the most useful way to think about them is a tool that you need to use at that point of time to keep growing. And whilst it is true, they might have a crappy banking app and maybe their customer service isn't great. You don't have to do anything with them apart from take the money off them and make the repayment to them each month. And if that's the necessary position that you're in to keep growing your property portfolio, it's just what you have to do. And the other thing I think I'd challenge some people on is that whilst there are some non-banks that are a lot more expensive than the banks, there's a whole range of non-banks that you'll probably end up with first, like First Mac, Resimac, Apollo, that are actually just as cheap, if not cheaper than the banks. They just serve a place in the market of helping you with additional borrowing power. So I guess that's just, that's the way I think about it, and the simplest way that you should think about it.
I think it's a really good point that you made there, that you don't have to have anything to do with it, but then other than take their money and make their repayments. We've got a loan. We have a loan with Pepper Money. Ooh. We haven't had, since we got the loan, I don't know whenever that was. That would have been in 2020, I think. 2020 we got that loan. The repayments are on autopilot. Like, no one cares. It's like we haven't spoken to them, haven't had anything to do with them. So there's I think it's an interesting point that you just go, okay, right, what are we worried about here?
I think the only thing would be, like, Callum, you mentioned at the start of the episode about the bank guarantees, and I think people thinking through mate, what if this tiny non-bank lender just disappears? What happens then?
It's a good thought experiment. So the first thing I would say is, and most people don't, but in terms of your bulk cash savings, most people will tend to have that in some bank's bank account where they do their regular banking with. But the thing about a loan book, so let's imagine this, theoretical small lender out there. Their loan book is an asset, right? All of our loans that we're paying each month, that's an asset to a bank. That's income that they're receiving. So what happens in that circumstance is that asset, i.e. that loan book, it just gets bought by another lender. That's the part of the business that has value and is easy to sell as long as someone is paying it. So, I mean, the worst thing that can happen is this non-bank lender doesn't exist anymore. It gets bought by some other non-bank lender, and there ends up being a different label on your mortgage statement. Like, that could be outcome number one. But I think the thing that people get twisted in their minds is it's which direction the money's going in. It's like they're lending you the money. You're not lending them the money. If anything, they're the ones that have got something to worry about.
Yeah, fair enough.
Yeah, what do they say? It's like if I owe someone $1 million, it's my problem. But if I owe someone $100 million, it's their problem. But it's kind of like they're the ones lending out the money.
Yeah.
Nice.
Awesome. Cool.
Well, that might be a good place to wrap. What do you think, Gabby?
I think so. Guys, if you've enjoyed this, I would love to hear from you. If you're in the chat, say goodbye, see ya. Or if you have any other questions as well that we didn't get to cover, if you are watching this not live and you've been thinking of questions, chuck a comment on YouTube. We do keep an eye on them. We will come back to you and give you answers. Or if you want to email us, you can email podcast@dashdot.com.au. If you want specific help with your finance strategy and maybe think about refinancing or loans or anything, you can obviously book in a call with Callum and his team. There's a link in the show notes and the YouTube description as well, so you can jump on. Totally no obligation. Like, you can hear Callum's ability to strategize here, and you can just ask questions and just working through what is the best situation.
And there's a whole team of people just like Callum, but with not as good mustaches, who are just as good at this kind of stuff.
True.
So.
There is a few good mustaches getting around, but thank you.
Yeah.
It's becoming like a Dashdot prerequisite. You guys with your modes. It's like only hired if has a mustache. No, so yeah, if you want to jump on a call with the team, I do recommend doing that. Whether you're new and you are just thinking about buying any kind of asset, you're brand new, perfect, jump on, have a call. Or if you're an existing client and you're not already working with Dashdot Finance, have a chat there. If you have properties outside in your broader portfolio, again, happy to have a chat and work through the best strategy for you. Goose, did you have something you want to say?
I do. I've got a couple of things. First, before anyone goes, make sure you hit the subscribe button if you haven't already. Also, think about somebody else who might benefit from this. This episode's full of info, full of very, very useful info. Everyone needs finance info. You can't invest in property without finance. So this is not just like an opinion piece and lots of like nice and big, fluffy, vacuous ideas that we can all go and intellectually massage ourselves around. This is really useful information. So if you know anyone who's thinking about getting into property this year or is already in property this year, send them this episode. So hit the share button, send them, just get the link, say, hey, I think you might be interested in this, send it to them. That's going to help them. It's also going to help us. So the reason we're doing this is we want to help more people. So the way that you can help us is you can help get this out to more people. So hit the like button, hit the subscribe button, and share this with somebody else as well. And also, yes, finance is the first step to investing. So book a call with Callum or his team. But also, if you're ready to invest and you want to get started, there's a link in the description for you to book in with the Dashdot team to talk about buying an investment property or building a property portfolio. We'll first start with helping you to develop a plan. Never invest without a plan. If you're thinking about investing, the very first thing you need is a portfolio growth plan, because without a plan, you are very unlikely to get to your goals. So make sure you get that started. We have a link there. You can book in a 15-minute call. Again, no obligation. We'd love to help. That's all I had to say, Gabby.
Perfect. I forgot that I had another plug that I was going to do, because I know that we have a lot of clients here. But guys, we're actually doing a client-only webinar next week. It's with Andy next Thursday at 7 p.m. Sydney time. Now, you won't have received an invite yet, but an invite will be coming, I think, on Monday. It should come through to your inbox. But it's with Andy, who's our innovation analyst, and he's like a portfolio strategy extraordinaire on the team. So it'll be super valuable. The title is How to Get the Highest Return on Invested Capital Possible from Your Properties. So if you are free on Thursday at 7 p.m., I do recommend jumping on that, and the invite will come on Monday. Otherwise, share this episode.
That's for clients only, though, right? So
if you want
to come to that and you're not a client, then you're going to need to book in a call, speak to the team, become a client before Thursday, so that you can go to the webinar.
I do recommend. Share this around. I'm already thinking through people that I want to share this with, because I think once you're on board with, okay, property is the way that I want to go, the next question is like, how do I approach finance? And I feel like we've covered a lot of things that people are asking. So if someone else that's thinking about property, thinking about how do I approach finance, share this episode with them. Callum, thanks for joining us.
Thanks for having me, guys.
Awesome. See you next week, guys.
See you next week.
Bye.